You know, most traders are idiots. I'm going to prove to you that they are, and I'm going to prove to you that it happens over and over again. If you're a normal person, it's likely that you've made this mistake. I'm also going to analyze the markets overall, give you a sense of where stocks, commodities, currencies, and the bond market are headed in the near term, and then we'll look at the trade of the week on INO. So the fear of missing out is a really powerful motivator, and it governs the stock market, and it's probably the greatest source of losses for traders. If you want to be a good trader, you have to overcome the fear of missing out. I'm going to show you some charts in a moment which will demonstrate that this is rampant in every hot stock. So what is the fear of missing out? Well, perhaps someone tells you about a stock that you should buy, and you ignore it because you don't know that they know anything. But then the stock goes up a little bit. Now you're intrigued. But it'll probably go back down again because stocks always go back down. And then it goes up a little more and a little more. And pretty soon you can't stand the fact that you are not in the stock. And so eventually, as it goes higher and higher, you think, well, my friend, the person that gave me this tip, was right. And therefore, they've been proven right in the market, and so I must also buy. Well, guess what? That's the fear of missing out that governs your decision to enter. Because you're buying because the market has proven the information that you were given was correct. And as it goes higher and higher, you're emotionally damaged by the fact that you're not in the stock. You start thinking about all the money you could have made. And as it goes higher, that fear of missing out grows stronger and stronger. And eventually you finally buy, and it's usually at the top. So why does this happen? Well, because the stronger a trend, the more conviction that investors have about the quality of the company. They don't think about value. You know, if a TV was $1,000 and then the next week it went to $1,100 and then $1,200, you wouldn't say, oh, it's a much better TV now because it's more expensive. It's the same TV. But with stocks, somehow we think that the quality of the company can be based upon how much the stock goes up. And so therefore, our conviction that the stock is a great one goes up as the stock goes higher. Now, not everyone does this, but a lot of people do. And let me show you the proof. Here is a stock that was one of the hot stocks in the month of December. And what I want you to notice is that when the stock was at its highest, the volume was also at its highest. See how the volume was rising? And in fact, as the stock topped out, it traded its highest volume. Now, if we think about volume as an indication of how many people are buying the stock, how many people are in the stock, well, that means that the most people were buying at the highs. When the stock started its upward trend back here, the volume was much less. In other words, there were far fewer smart people than there were idiots. Let's look at another example. This is a swing trade on a stock that went up really well over the last couple of weeks. And you can see when it started, the volume was higher than usual, but it wasn't exceptionally high. And as the price went up and as the trend went parabolic, look what happened to the volume. And the stock traded its absolute highest volume when the bubble burst. And from there, it went lower. There was a massive number of buyers chasing the stock. So what's the lesson? Well, here it is. When trends go parabolic and volume is getting higher and higher and higher, do not chase. Do not succumb to the fear of missing out. If we go back to this chart, see how it goes steadily steeper? That's a parabolic trend. And when trends go parabolic, the bubble is about to burst. In fact, I have something that I use called a bursting bubble candle, which is when the trend goes parabolic, When price hits a new high and closes below the open on that candle and volume is high, you can see the volume there was higher than any bar leading into it. So you've got a red candle hitting a new high with abnormally strong volume in a parabolic trend. That's a time to sell. And you know what? Most people will be thinking about buying because the emotional state that they're in, that fear of missing out, is at its very highest the stronger the stock is. All right, let's get into this week's market analysis. We'll take a look at the S&P 500 first, and you can see that last week we had some weakness in the S&P, little pullback, which is not unreasonable given the gains that we had through November and December. A little bit of profit taking. Now last week I discussed that that was likely to happen, and the reason why is because the market had rallied up to resistance at its old highs. And anytime a market runs up to resistance, it's likely to pull back from that resistance. How far is it going to pull back? Well, support at the trend line is quite far down. You can see where I've drawn that area of support. We may not get there. We may simply pull back for a week or two and then take another stab at breaking through that resistance. Hard to say. I'm not too worried about a major correction or pullback yet because we haven't made a falling top. If you look back to this time zone, we had this initial pullback, a falling top was formed, and then that real significant weakness through the balance of 2022. We don't have the falling top yet, and so let's not get too worried about it, but it does deserve a little bit of caution. On the NASDAQ 100 QQQ, let's take a look at the 3-year on that one. You can again see a little pullback. This actually got through this level of resistance. It managed to just tickle through it, but not really a substantial breakout. Pulled back a little bit last week. I think we could get a couple more weeks of weakness, but again, I'm not too worried about it yet because we're coming off of new highs, not off of a falling top. While the small cap stocks in the US didn't have the same big upward move that the large cap stocks and that the tech stocks did. And so they don't really have as far to fall. They also have come up to some resistance and they got stuck. We expected that to happen. Again, I talked about that last week. And we may see another little weakness of a week of weakness here. But I think ultimately we're going to just build a base underneath resistance and then try to break out. The critical thing will be what the bond market does, and we'll talk about that in just a moment. Looking at the Canadian market, quite a bit different on the Canadian market because it did not have weakness this week. You can see it held up quite well. And like the small cap stocks in the US, it did not have much of a big run over the last year. It's been stuck in the sideways range, had a little rally in November and December. I think it will stall a bit here, but ultimately headed for those highs over on the right. Now we'll talk about the reason why that may be in just a moment, but first, let's take a look at the gold chart. Gold's been choppy, but generally going in the right direction, going up from left to right, so that's a positive for gold, but it's quite volatile, and so it's a little bit difficult to trade because you can get whipsawed out of your positions quite easily. You need to have fairly wide stops on the gold right now. But the trend is generally up. I think it's probably going to stall here, so more of a neutral chart than anything. Here's the interesting chart though. USO has been really kind of a weak place to be the last couple of months, but it is now coming close to breaking this downward trend line from a rising bottom. And if it can do that, if it can break this downward trend line, then I think gold might be the place to trade for a little while as it recovers the lost ground that it's gone through October and November. And that would be supportive for the Canadian stock market because, of course, a lot of energy stocks listed on the Toronto Stock Exchange. And that could be one of the reasons why the TSX is holding up better than the US markets. All right, let's take a look at currencies. We'll start off with the US dollar, UUP. And we'll take a look at the 1 month chart. Now, we had this big gap 2 weeks ago. I'm not going to worry too much about that now. We are starting to build some rising bottoms and have a little resistance right there. If we can see UUP break up through that, then I think it moves higher. And the reason may be a little rise in interest rates. We're going to talk about that in just a minute. But first, Let's take a look at GBTC, which is your Bitcoin chart. And it's been in a steady uptrend for a few months. Don't see any sign of that trend breaking. It is risky to enter now. You're chasing a little bit, but those Bitcoin stocks, related stocks, are doing well. Some of them went up a little too fast and made a little pullback. Mara at the top of the video, an example of that. They're a Bitcoin miner. They went absolutely parabolic to the upside, pulling back, but that doesn't mean that it's over for them. They just may have to take a little breather because Bitcoin is still strong. How high can it go? Well, there's really no resistance until you get up into this range. And so we're only like halfway there from this break. I was first bullish on Bitcoin right there when we broke up from a rising bottom through resistance with abnormal price action. That started the upward trend. Took a few months to get going, but of course it's really been moving nicely since then. And finally, the chart of the bond market, TLT. So when this goes up, interest rates go down. And you can see that it went up nicely through November and December. And that's why we had that Santa Claus rally. That was supportive for stocks. Well, last week it went down a little bit, which meant that interest rates went up a little bit. And that's negative for stocks. But unlike, or just like those stock markets, it's not coming off of a falling top. It's coming off of a new high in this little trend. So I don't think it's a big deal. It could pull back a little bit and then resume the upward trend. Where we need to get worried is if the bond market and the stock market pull back, fail to make a new high, build a falling top instead, and break down from a falling top. If that happens, then we're going to get more defensive. But for now, we're going to say it's reasonably okay. All right, so my ratings then. U.S. stocks, bearish on the short term, neutral in the long term. Small cap stocks, neutral on both time frames. Canadian stocks, bullish on both time frames. Gold, oil, neutral on both. Oil is an upgrade. It's been bearish for a while, but it's starting to look a little better. U.S. dollar, short term neutral, long term bearish. Bitcoin, bullish on both time frames, and bonds, bearish on both time frames, but that's not too bad. I think we could continue to see a recovery in the bond market, which means a drop in interest rates. All right, let's now look at the trade of the week. This is an example of a stock that we would have traded in the active live service that we offer at Stockscores, where we monitor the market in real time using algorithms, monitor the entire US stock market, looking for stocks that are behaving abnormally. And the indicator that we use for that is my own little concoction called an action candle. And you can see an action candle right there. It made an abnormal price move with abnormal volume. That's what an action candle is. It's indicated by that little yellow dot. The pink dot means it's just abnormal price action. So this one here has abnormal price, but the volume was not abnormal relative to its previous candles. Either way, nice breakout there from a cup and handle pattern. Action candle. Our computers pick up on that. We display it in real time. And the stock went up quite nicely, moving from roughly 62 cents to 80 cents over the next few hours with very good liquidity, a very actively traded stock. Now, that's a swing trade. You can also day trade these situations because we use that same indicator. There's that little yellow dot right there, breaking from a pullback. So it goes up, it pulls back, and it broke the pullback. That's what I call a pullback play. Another one of the strategies I teach in the Stockscores education material, again available at stockscores.com. And it went for a nice run going parabolic, breaking the parabolic trend there. To me, that was the time to exit at about 7 times risk. So risk $100, make $700. Risk $1,000, make $7,000. Those are the kind of things that I teach. Those are the kind of things we do in Active Live every day. Again, go to stockscores.com for more information about that. Well, I hope you've enjoyed this week's video. Leave a comment. What do you think the market's going to do next week and over the next month? Up or down? I'd love to hear your thoughts. Hope you've enjoyed this week's Market Minutes. And if so, click on the like button. But most importantly, trade well.